Okay, folks, time to get to the last part of capital structure and restructuring issues. Then we get into timing and financial issues. So let's talk about the APV approach for optimal capital structure. This alternative is similar in terms of objective. You're still trying to maximize the firm value, but now you're assessing costs and benefits of the debt in dollar value terms rather than using the cost of capital approach. Now, what analysts do in practice is usually the first two steps, and then they skip the third step. And the reason is that the inputs there are very difficult to get. So the result here, you get the value of a firm going up as you borrow money, because you're counting in the tax benefits, and you're not then counting in the bankruptcy costs. So that's quite a problem. So what you need to do is try to estimate the expected bankruptcy costs. So the two inputs you need first are to estimate expected bankruptcy costs by, looking at synthetic ratings and working from there. That's actually pretty easy. The second one's going to be harder to get. There have been some attempts to measure the magnitude of indirect bankruptcy costs, concluding, first off, indirect bankruptcy costs tend to be pretty high, sometimes 20 to 30% of firm value. And also we note that indirect bankruptcy costs as a percent of firm value are different for different firms. Generally, they tend to be high for firms that produce longer life assets than for those assets with shorter lives and for firms where their reputation tends to matter more. Here's the Altman study on bonds that's updated. This update happens every year by Altman at the Stern School. It's the probability that a bond in each of the rating classes would default based upon actual default rates over the 10 years of bonds in the rating classes. That one looks like a 2008 update. So you can, of course, go find Altman's updates on his webpage to get a little bit more clear recent information. For our application and practice, you can implement the APV method, estimating the unlevered firm value first. Use a shortcut to derive the tax benefit from the current debt, and the indirect bankruptcy cost would be an assumption right from the midpoint of the 10 to 40% range for the companies. What we get here, Disney's optimal debt ratio, slightly higher than when we did it under the cost of capital approach. Now, I think the slide's wrong here. It's written at 40%. I think it's running to 50% now. 24, let's look at expected firm value, 40, no, it's still at 40%, all right. All right, so I don't have the book handy, and this is the updated slide. I'll have to go back and check this, and if I need to redo something, I will, but yeah, stated 40% for our purposes. Keep in mind the APV value might actually wind up having a higher optimal. All right. Going to relative analysis, most firms pick their debt ratios looking at industry averages. So they want to stay kind of close to the average, right? And the idea there is managers can cover themselves if they make some kind of a mistake. You know, it's the notion of, well, everyone made the same mistake kind of defense. And they try to stay close to industry averages, right, because the rating agencies and the equity research analysts always use those averages for their commentaries, and their analytical conclusions are somewhat built around those. If you look at comparisons, right, Disney's operating at a debt ratio lower than the other firms in its industry in both market and book value terms. Here, Vale and Tata have debt ratios much higher than the averages in their sectors. So what we're doing here with, comparisons is assuming that firms in the same industry really are comparable. And, that we think, on average, firms under competitive conditions should be operating pretty closely to optimal. But you can actually question both of these assumptions. Firms within an industry often have very different product mixes, different amounts of risk, and discount tax rates, and different project returns. For instance, look at Disney. Disney's considered an entertainment firm, but it's got a mix of businesses very different from Lionsgate, which is really a movie company. It's different from Liberty Media, which is a cable broadcasting company. Disney's size and risk characteristics are very different from smaller firms that are really still inside that industry group. And right, you got a bigger problem for Disney and Vale. These are multi-business companies, and if you pick a particular sector, then it's becoming difficult to justify the comparisons. So one way to control for the differences across the firms is to rely on some variables from regressions that give us some proxies for the factors that are basically driving the debt trade-off. Okay, so that's what this next simple example kind of gets at. So what we'll do is assume a linear relationship exists between the independent variables and the debt ratio, and that you could basically take the variables, transform them along the relationship. If you need to, it could be that it's nonlinear, but for our purposes, we'll just plug the values in. Here, the author does it for Tata Motors with a regression that suggests that the company's underlevered relative to comparable firms, and what you're doing is controlling for differences across the firms. And of course, the low R square is going to cause us to have some large prediction errors. We got to watch out for that. Now, this looks at the entire market using some variables. This stuff comes from Value Line. And the tax rate is our, call it a proxy for the tax benefits. The closely held shares is a way of thinking about the disciplinary power of debt. The EBITDA to firm value is the capacity to generate the cash flows. The intangible assets is a way to kind of mark out the agency costs. And the growth in the earnings per share, it's like a flexibility issue, this notion of expected growth possibilities. And, you tend to see really low R squares for these, by the way. So, the aggression, though, can be applied, and you look at the debt ratios of the other firms in the market, and Disney's financial characteristics, and plug them into the final regression. And so you'd expect Disney to actually have a debt ratio of 29%. The actual debt ratio is 27%, so Disney's just slightly underlevered doing it this way. Now, of course, that could be different from the optimal because it's based on the assumption that the firms are getting their debt ratios right. But what if all the firms, say, in your data set are underlevered? You're going to just get, of course, a lower predicted value from your regression than you would for the cost of capital approach. So, summarizing, what we can see here is we've got Disney underlevered no matter how you slice it. Vale is pretty close to fairly levered if you assume income is going to bounce back. Tata Motors is overlevered, and Baidu is kind of mildly underlevered. Right? So I'll stop there because we got a good break, and we're going to move to the next unit, start working on how we get to optimal through financing choices and the timing question. So put this one up on the web so everyone can review.